Winter is coming. The chilling watchwords of the House of Stark in Game of Thrones. It feels like it today, here at the beginning of March in the UK, with snowstorms descending across northern Europe and mirrored in financial markets that might be processing that more interest rate tightening may be coming, and with it, a trickier economic climate. Yet business and market cycles are woven into the fabric of capitalism, despite central banks' departures and efforts up to the last 12 months to distort the playing field. And allocating capital is an essential requirement of the savings and pension worlds. In the last few episodes, we've been understanding how some of the world's super allocators think about and implement their investment policies. And with the growth in complexity and responsibility and sheer size of global investable assets, in tandem, we've seen the growth of the role of the pension consultants, Mercers, Towers, Aon, assisting these organisations. And today we're going to Mercers and specifically to their global head of investment research, Jo Holden. So Jo, welcome to the podcast.
Yeah, thanks Simon, it's great to be here.
Well, we love to start just with a little bit of context. I think you might be in Manchester, but you've told me already that you were born in Burnley. So I'd just like a little reflection on, was it an upbringing where you discussed actuarial matters and investment portfolios?
Yeah, it probably wasn't, to be fair. I mean, I think it's probably, if I was going to describe my background, I had a happy but pretty unremarkable and certainly not a stereotypical sort of city career background. As you said, I sort of grew up in Burnley, which I don't think is particularly famous for producing investment consultants. Although, I don't know if you saw it, the recent Netflix film, The Bank of Dave, which was sort of based in Burnley, might suggest it's got some potential. I don't know if you saw that actually, but it's pretty true to my recollections of living there. It's well worth a watch. But I think, my mum and dad worked hard. They kind of divorced and set up two households just before interest rates peaked in the early 90s, which you can imagine wasn't particularly easy. But I think both parents were very, very centred on my brother and I. And, we went to a pretty robust, comprehensive school. Maths and science was my thing. I had a place at medical school, which I think was probably a much more obvious aspiration than moving into the world of finance. And I guess probably just for the simple reason that you knew growing up in the north that hospitals existed, less so kind of the city. I didn't go to med school and become a world-renowned heart surgeon. I kind of just got a bit of a gut feel in the summer post A-levels that it wasn't for me. And I do remember my mum kind of marching me into school. She thought I'd gone completely mad. I mean, she was a nurse and understood the concept of me being a doctor, but she had no idea what anybody was going to do with a maths degree. And, at school were brilliant, to be fair, and kind of convinced her that maths might actually be quite a sensible thing to study at university. But I think even at university, I'm not sure there was a great awareness of the different sorts of career paths that you could go into. I think pretty much 99% of people on my course either did accountancy, teaching or actuarial work. And I think I probably kind of fell into the latter, partly because the other two didn't appeal, but probably because I was just morbidly interested in the concept of studying mortality as an actuary. So I think, there's something in that really that maybe we'll talk about later about sort of how we attract more people into our industry, because there are so many kids sort of across the country. You have absolutely no idea what we do. And if we genuinely want to sort of increase the levels of diversity with our industry, which, oh my word, we definitely sort of still need to do, then I think there is some sort of interesting lessons in that perhaps.
Yes, well, we definitely want to come back to that. Now, if I've done my research correctly, it looks as if you sort of segued from university into Mercer's almost without anything in between. Was that right?
Almost. I had a couple of years at PwC on their graduate programme, sort of doing their actuarial programme, but sort of quickly realised it maybe wasn't for me. And Mercer came knocking. And that was the first time I sort of realised or came into contact with the idea of investment consultancy. And I guess sort of 21 years later, haven't looked back.
Well, you definitely are one of the most loyal employees who's been on the podcast. Let's just talk about Mercer's at a high level. I think you're owned by Marshall McLellan, but just maybe give us a sense of context, the history, size, activity.
if you don't know very much about Mercer, we have been around for a long time. As you say, I mean, we're part of Marsh & McLennan, but Mercer itself has been around for about 75 years. And basically, we provide advice to institutional investors, which is my part of the business. But we also more broadly give advice on health and career issues to employers. Now, within the investment arm, we are a global firm, as you sort of alluded in the introduction, and we've got $16 trillion under advice. And in terms of assets under management in our fiduciary or OCIO business, we have about $415 billion, which makes us the largest of the OCIOs sort of across the globe.
Right, and an OCIO is an outsourced CIO office for those who maybe are less familiar.
Yeah, that's right. Some people might call it fiduciary management. Some people call it delegated. We sometimes call it investment solutions. It's another of those sort of really unhelpful things where there are sort of 27 different variations on a theme, but it's all the same thing.
So the 101 question is, why do investing institutions need consultants?
So, in my opinion, look, I mean, a good consultant facilitates good decisions. You know, particularly a lot of our larger clients know just as much as we do, if not more, particularly in some of the more sort of technical areas. Everyone's got their own expertise, right? And I think it's our job to be objective, to challenge, but also to bring that sort of broader context. You know, I mean, we do have a good window on the world that we can share with our clients. You know, we talked about the level of assets under advisement that we have at Mercer. You know, clearly it would take an awful lot of larger clients to make up that number. So hopefully just that sort of broader context of global experience. But it's a resource thing as well. I mean, you know, we can bring a lot more resource than individual organisations can provide themselves, particularly around things like manager research, that sort of is my particular area at the moment. And I think, you know, we like to think of ourselves as being a productivity aid rather than a replacement for in-house staff or decision makers. But then we can also bring a discipline around governance. So I'd say I don't think any good investment consultant would say that the value that we bring is by being the oracle on all things investment. I think it's very much about facilitating decision making in all sorts of different forms.
So we're going to talk about manager selection and research, which is your expertise, but you and your colleagues have written some quite interesting work, and you sent me one of them, which was sort of essentially placing this environment in a historical context. I'm minded, I think it was Churchill who said, the further back you look, the further ahead you can see. And there appears to be a shift in climate. Just maybe encapsulate how you're thinking about the world and what that might mean.
Whenever we sort of put these papers together, particularly when times are difficult, it leaves you sort of thinking, gosh, like who would be a decision maker? I mean, I say our clients do not have an easy job. And I think if we look at, you know, the paper you refer to, we wrote it towards the back end of last year, and, you know, it was a year of flux. You know, I mean, we'd had a bear market, we had governments that were, I think, probably starting to face up to sort of extraordinary levels of debt. We had inflation ballooning, sort of sharp rises in interest rates, but also, you know, sort of a war in Europe that, you know, it still feels, you know, sort of, it's horrible to say. I mean, it's, you know, but it really gave us a wake-up call on some of the sort of more complex, geopolitically sensitive supply chain issues, which, you know, affect so many things, not least, you know, some of the maybe good progress that have been made on all things sustainability and climate. So, yeah, I mean, I think flux was probably the word that we used the most when we were starting to put that paper together. And essentially what we do at the end of every year when we're thinking about what's going on in the world and putting together this themes and opportunities document, as we call it, because then by theming, you can sort of, it's almost a way of translating things into more pragmatic and implementable ways. I mean, it's a grouping, isn't it, really, aside from anything. So we had 3 themes for this year and beyond. We had history rhyme, and this is really about thinking about things like inflation, high interest rates, things like the resources conflict that I've mentioned sort of with the war, etc. But really just sort of thinking about those kind of in the context of lessons learned in previous years, but with the benefit of a much wider toolkit. I mean, we have much more in our toolkit than perhaps colleagues might have had in the 70s when we had some of these other sort of issues that we're facing now. The second of our themes is position for transition, which obviously is fairly obvious, and it's been a theme of ours for the last few years, actually. And I think what we're trying to do here is get real about what transition, particularly with reference to climate, what it actually means, but against a bit of a pushback in some regions. I guess we're thinking about the States in particular on ESG issues. And then our third theme we called it degrees of freedom. And that was really about governance and the fact that, the more well organised a decision maker is, and I talked about good governance and discipline on that a couple of minutes ago, that being well organised can actually be a pretty powerful tool. And I think, it's often said, I don't know whether it's still said, it depends on the sort of where we are in the cycle, that diversification is one of the only free lunches. I actually think good governance is sort of higher up that list when it comes to thinking about sort of easier fixes to help us make good decisions.
So let's just pause on one of those, which is a higher rate environment has unfolded quite quickly. If there are historical parallels, it could be that, in fact, it persists. And whilst you get some relief on inflation, it proves to be transitory. And we go through a cycle where, in fact, negative real rates persist. And fixed income investing, as we know, was a very dangerous asset class to be in the 1970s. How, when you write about that, does that then follow to a discussion and a possible action with clients?
So there's never a single right answer with clients. And I think sort of accepting that, by the way, is probably sort of one of the things that differentiates a good investment consultant. But look, particularly when sort of things, the world is in flux, the sort of the term that we used earlier, and the world is certainly a lot more complicated than it was in the 70s. We are expected to have opinions. So, we are paid to have opinions by our clients. So we do a lot of work thinking about, stress testing the sorts of solutions we could put in front of clients, and we, advise them to stress test those solutions themselves. But making sure that sort of clients understand the various options that are in front of them, they understand the pros and the cons, but also showing that we've done a huge amount of work behind the scenes to make sure that our actions are workable, they're pragmatic, they've not been developed in some kind of classroom or a vacuum. We spend a lot of time reading and listening and forming opinions in-house, but we also spend a lot of time discussing our ideas with asset managers who can, are the end point for solutions for our clients. We know that there's a robust body of evidence behind it. We know that our clients understand the pros and cons, but we also know that there are implementable things that they can do and ways of measuring whether or not those things have been the right things to do. And I think the other thing that we're increasingly having to do when we're thinking about building solutions to problems for clients is recognizing that everybody always has more than one problem. So if you're a UK defined benefit investor, you're worried about inflation, you're worried about cash flow, but you also might have sustainability goals. So the more solutions that we can put together that cover lots of different goals, the better. Because, it's not always just about a risk return outcome. It's also about governance and what's manageable and the sorts of things that clients can actually practically get to sort of work within portfolios given their own time constraints. So it's kind of multifaceted, but I think we're thinking harder and harder about making things as simple as we possibly can do, but also as sort of pragmatic and implementable as we can do too.
So in parallel with the growth of the consultants, we've seen the concentration and power and growth of the big asset management firms that offer, on the one hand, process and resources, but large organizations can suffer from stasis, and smaller organizations in the asset management arena are often those that have greater flexibility, agility, and are often identified with more alpha. How do you reconcile those two forces? And the research process has got I guess, a lot more complicated because the inclusion and growth of private assets is suddenly requiring, well, more skills, different skills. How do you organize yourself, public versus private?
So at the moment at Mercer, we sort of took the view, partly through a series of acquisitions, that we would have a specialist alternatives brand. Now, we don't have people in boxes. We have people who have sort of moved and sort of, their career paths have moved between sort of traditional and alternatives. But obviously, there's a consistency of approach, there's a consistency of philosophy, but we were recognising very much that sort of we do need sort of deep specialisms in each of the different areas. Now, moving forward, sort of we all work as one organisation. We are very clear about the fact that the total portfolio approach is what most of our clients are looking for. So we don't want people to be too sort of focused. And I think, increasingly we're also hearing lots from investment managers about their own strategy and focus, and thinking about that hybrid that will exist to a greater extent going forward between sort of public and private. But yeah, I think to sort of go back and just make sure I'm answering the question, Simon, it's about making sure that you recognise where a consistency of philosophy in terms of the sorts of firms and strategies that you're looking for is important, but then also just making sure that we do have the right level of due diligence, expertise, process across a wider sort of remit, I guess, sort of within alternatives. Because I think it just depends. We've certainly got examples of people who've moved across, and I think particularly in the fixed income space, actually, we probably do have more people who've moved from sort of looking at corporate credit and going across into private debt. If you were to draw the Venn diagram of sort of traditional credit and private credit, maybe the bit in the middle is bigger for credit than perhaps it would be for equity.
So I'd like to talk about decision making and mobility. You've written about the dangers of groupthink. I'm conscious, having sat on investment committees, the larger they are, the less effective they generally also are. Tell me why you are even writing about the dangers of groupthink.
Quite often a lot of that sort of criticism or the conversation is centred towards asset managers. We do generally tend to find there's not a huge amount of diversity when it comes to decision makers within the asset owner space either. Now, look, there are all sorts of different ways of measuring diversity, and what we're looking for is cognitive diversity. And, again, being a defined benefit pension trustee isn't always, it's not always easy to find lots of people to put their hand up to do that. So, there are all sorts of things that contribute to why we maybe don't have a huge amount of diversity. But I just worry that when, in a situation where we don't have a huge amount of diversity, things are moving very quickly. Are we really working, can we work hard enough to make sure that you're making decisions with integrity, with empathy, with kind of compassion, all of the things that make more rounded decisions, or do we have no choice but to sort of go with the opinion or the decision making of the loudest and most knowledgeable person in the room? I've heard sort of enough maybe comments or thoughts about how we went through the LDI crisis to just make me think, could we think about helping clients with a better framework for decision making, or trying to get sort of more diversity of thought into their framework of decision making that might be useful?
Don't you think that maybe an even bigger challenge is just the human challenge, that we oscillate between greed and fear? You get a huge backup in yields. I've actually read that UK pension funds in aggregate have moved to a surplus. I don't know whether that's right. And a rational person not drawn up in this sort of, surge in yield, sort of going, oh my gosh, we've been searching for yield. Now we have a solution. Let's just take a deep breath and let's change our allocations, as opposed to, oh my God, the UK economy is coming to a crunching end.
Yeah, no, I think that's right. And I think sort of, I can imagine that there might be lots of trustees listening to this podcast and sort of saying, what on earth is she on about? Exactly to your point, we're all in surplus now, so I'm sure we did very well. And that's kind of not my point. I'm not criticising necessarily the decisions that were made. And sometimes you don't even know if you've made a good decision in the world of investment until a very long way down the road. But I just, the situation that our clients were in during the LDI crisis was scary, and possibly not what a lot of them had signed up to. And I think, sort of making decisions in those sorts of very high pressured environments. I just think, if you go back to what I said right at the beginning about our job is to facilitate our clients to make good decisions, then I think we have to stop and just have a little think about how we might help clients make better decisions and whether or not sort of group, how can we facilitate, given a lot of the stuff that we do thinking about asset managers and diversity in decision making, are the lessons that we could sort of feed into that process there in terms of sort of helping that sort of group think if it exists.
And the other challenge that you have is you have a fiduciary responsibility, but you're also trying to balance the world of sustainability and all that goes with it. But investment return is absolutely key. And then you come to sectors where, whether it's natural resources or energy, where there are strongly held views, but return is absolutely important, absolutely vital. It's the lifeblood of those, pensioners whose, assets these pools represent. How do you approach that? Because I'm not suggesting that's easy.
No, it's not. But on a personal level, it makes me a bit tetchy, actually, when I'm kind of asked this question about fiduciary duty and kind of and ESG. And again, apologies to people who are listening who have maybe sort of heard me say this before. I don't actually think that there is a conflict between ESG or sustainability and fiduciary duties. And I think a lot of people get very hot under the collar about it quite unnecessarily. There are risks and there are opportunities associated with sustainability and ESG. But just like there are risks and opportunities associated with duration if you're a fixed interest manager. Now, fiduciary duty is about risk management. Of course, it's about return enhancement and all sorts of other goals as well that you might be sort of working for. But for me, it's about risk management. And ESG is a risk management tool. It is not about someone telling investors what to invest in or sometimes what not to invest in. It's about being aware of the risk implications of ESG or sustainability and making informed decisions. So to me, there is no conflict whatsoever, because I'm not saying that to be an ESG informed investor, you must be doing X, Y, and Z. You just need to be aware of the potential implications like you are with any kind of investment related factor.
Well, you manage that without a hint of tetchiness. It is a recurring discussion around investment committees and with clients, and, we have to have that conversation. I suppose that as you look at the map of opportunities, typically in traditional asset classes, but some of them have extended with the arrival of newer investment sort of styles and themes. Are you intrigued that portfolios could look quite a lot different a decade hence, and if so, how might that be?
See, I don't think that their asset allocations will look that different in 10 years' time, because as you mentioned sort of a little bit earlier, a lot of them are now in surplus. I think, we'll have a lot more sort of buyouts, etc. Or if we don't have buyouts, we'll have runoff portfolios that, don't need lots of innovation and change within them. So whilst we might not have portfolios that are full of, sort of Bitcoin and AI and all sorts of things, or that indeed asset allocation is derived by typing something into Chat GPT, I do think that, I'm hopeful that we will have more forward-looking portfolios when we're looking at addressing challenges like climate change, etc.
You've written about the power of collaboration, and at one level, one would find that's not a controversial topic. I think you might have some particular perspectives. Is that right?
We talk a lot about engagement and collaborative initiatives and how the power of many voices is stronger than sort of the power of one. And I think that's, there is no doubt that is true. But I think, again, if you sort of on a more pragmatic level, if we look at some of the things around net zero and engagement and smaller to mid-size asset owners really trying to get their heads around whether or not, like, how do I engage? How do I collaborate? Because we see all the larger investors doing it. We see these big initiatives. We might also, if we were being critical, perhaps see lots of tick boxing that goes on about all sorts of things that people have signed up to. But is it really moving the needle? And does collaboration always really involve the many sort of hundreds, thousands of smaller to mid-sized investors? Like, I'm not sure that it always does. So I chair or co-chair the Investment Consultants Sustainability Working Group in the UK. And one of the things that sort of a group of us on there are thinking about at the moment is how we could actually think about more pragmatic frameworks to cut through all of these collaborative initiatives and really focus on how asset managers could step up to the plate to sort of help smaller to mid-sized clients with that sort of that engagement piece. So, you know, instead of saying we're handing all of this engagement and collaboration over to our asset managers and leaving them to it, how do we actually get smaller to mid-sized investors involved in this? And I think the managers and consultants have to facilitate that, just because there's a tangent of something kind of in there that says that might be a more pragmatic way of affecting change than maybe one or two larger investors doing it sort of together. And that's not to criticise the larger ones, and it works, of course it does. But collaboration doesn't always involve everybody, and I think there might be better ways of working on that.
So, Jo, you mentioned something that's been echoed before by a couple of smart guests, which is the importance of neurodiversity in constituting a board or an investment committee. There is, of course, a recognition of the gaps and deficiencies that have, been very evident over decades in terms of minorities, in terms of women, and again, not an easy solution. Just maybe the two or three things that you would like to see in approach, or that you're drawing in the way that you're running your organization, that you think others should be thinking about.
Yeah, so I think the first thing is, a recognition that it's not easy. It's not easy to define. It's not easy to measure. There are lots of different ways of defining diversity. I think, we've always had cognitive diversity at the heart of our manager research process, which is entirely sensible, but then you can pick that apart and start to think that it's also a very easy label for people to hide behind. We're very cognitively diverse, but, we're all the same age. We all went to the same school. We all go on holiday together. But of course, we think very differently. You do see that. You do see that a lot. I think I have a niggle, fairly deep-rooted niggle about lots of initiatives related to diversity that actually sometimes disenfranchise the people that you're looking to benefit. And the more and more I think about it, both in terms of sort of, the way that we're looking at asset managers and their sort of culture, and also the way that we run our own teams, is that I think inclusion probably has to come before diversity. And again, it's really difficult, isn't it? Because I'm not an expert at all, and I'm sure there'll be lots of people screaming. I was almost going to say at their radios, and people don't listen to podcasts on radios, do they? It kind of maybe shows my age, but you get my point. So we did, off the back of our investment forum, a couple of years ago in London, we did a diversity workshop for asset managers, and we were really just trying to gather data on opinions about how asset management organisations worked, and we asked all sorts of questions around diversity. But then we asked one about inclusion, and we had 100 plus kind of participants in this workshop kind of survey that we did. And we asked a question about how inclusive people felt their organisations were. And we only split the data by male, female when we were doing this. We only had one level of diversity. But it was something like 80% of male participants felt that their organisations were inclusive. And it was like less than 50% of women felt that their organisations were inclusive. So it's almost like it doesn't matter well, of course it matters how diverse your organisation is, but actually it could be very diverse in the face of it. But if people don't feel included, like, it's not working, is it? And I think if we could work more on being inclusive and having a reputation for being an inclusive industry, we would then attract a more diverse cohort of people to want to come and work with us. So I do think we've got a lot of work to do. There are no answers. We certainly don't have sort of all the right answers on that. I mean, the other thing that we came up with in sort of some of the work that we've done is that I think the asset management industry is broadly attracting and promoting people at a 50-50 gender split. So like we're doing much better than we were. But if you're just bringing people through at 50-50, like you're not going to change anything. So what do we want to achieve? And are we comfortable with some of the things that we might have to do to achieve that? And actually, do the people you're trying to target feel comfortable with that too? So I think we could have a much more honest conversation about it, to be honest.
Great. Well, as I move to some concluding general questions, I realised that I didn't go back on a really interesting and the only guest of over 100 who said that they were somewhat obsessed with mortality data.
Yeah, probably not anymore. Come on. This is when I was, 18 or 19 and probably considerably more geeky than I am now, I suspect. But
why?
I don't know. I think it was just a morbid fascination. I mean, come on, I was the girl who wanted to be a kind of a brain or a heart surgeon from being about 11 or 12 years old. I don't know whether you will want to keep this in here or not, but the very first job that I wanted, my mother was horrified. They have the things at primary school about sort of what job would you like to do, dear? And everyone says doctor or a lawyer I wanted to work on the tripe stall on Burnley Market because they had this amazing glass sort of tank that all this horrible, yucky stuff, I didn't even know what it was. I was 6 or 7 years old. That was just, it was just gruesome. So I think there was an element of just general sort of morbid fascination in all sorts of things when I was a small child. That does not persist, just to be clear. I certainly don't have a kind of morbid fascination now, but come on, when you're doing maths at university, there's not a great deal of interest. So perhaps you look for the macabre in sort of things for a bit of general interest.
My wife also studied maths at university and also worked for a management consultant, not an investment consultant. So maybe there's some parallels. But from glass tanks to glass ceilings, have you run into glass ceilings along the way?
So I really haven't. Although, I was once made that comment to someone and was accused of having Stockholm syndrome, having worked at Mercer for such a long time, which, was kind of like, it was an interesting thought, but genuinely not representative of my experience. And I think, Simon, it goes back to those thoughts I had around inclusivity. I've never been treated as anyone other than me. And I think, I've had fantastic mentors throughout my career, great female role models in, sort of very senior positions at Mercer, which I guess, sort of always helps. But always great, male role models also who have, sort of, I think, seen what I could bring to the organisation for me, not because sort of I was female. Perhaps I've been incredibly lucky and sort of worked in a great organisation, but no, I genuinely haven't. But I appreciate that I'm possibly unique in that respect.
No, I don't think you are. But you would be unique if you hadn't had, along with lots of our guests. And I just wonder when those have come along, whether it's the promotion that didn't happen or another, how you've dealt with setbacks.
I think it's easy, isn't it? As you sort of, you're starting your career or you sort of climb in the ranks and to get very focused on you. And I think probably one of the best pieces of advice that I got was that, just to occasionally take a step back and be a little bit self-aware, but also to think about the fact that you work in a great organisation with lots of other great people. And it's easy to focus on your own attributes and not think about those of those around you. I can't think of anybody who hasn't been knocked back for a promotion or, hasn't failed an exam or, whatever else it might be. But, I think sort of, I'm not going to be sort of very glib and say those things sort of make you stronger. But I think, those things can push you to achieve more, even if it's just a competitive edge around, I'll show them next time round. And I think those sorts of things in terms of sort of improvement of sort of what you're doing can certainly sort of help if you have had a knockback.
And finally, because both Will Campion and myself have two daughters, and we've talked a lot about women in finance and the importance of promoting that theme, what advice would you give to young women listening to this podcast where you've said some really illuminating things? What advice would you say if they're thinking about a career in finance?
I think I'm not sure it would necessarily be sort of specific to finance, but I think it's just about having the confidence to be yourself. Don't, and again, maybe that advice also is to sort of young boys out there thinking about a career in our industry. I think gone are the days of a stereotypical sort of industry, sort of, a representative within finance. It is probably a lot more diverse and eclectic than we are given credit for. I think we thrive on bringing lots of different sort of people into the industry. So absolutely be yourself, but don't be afraid to find something and really sort of push at something that really interests you. There is no doubt that my career was enhanced, or that, sort of I got to where I got to by finding things that either I was very good at in some circumstances, or that nobody else wanted to do and you could make a niche out of, which, is sort of always something I talk about when I'm asked for career advice. But yeah, I think just have the confidence to be yourself. And if it's not, again, doesn't sound too cliche, to be your authentic self when coming to work.
Got it. And that's super. That's a great place to end. I always take a couple of important points that have been made along in this conversation. Two you made, one earlier on I'm going to repeat, is that it used to be diversification was the only free lunch. You're actually making another point nobody's made before, which is good governance might be the only free lunch out there. And that comes back to the ESG and just how important that G is. So that's number one. And that in your world, particularly, clients typically have more than one problems. Now, that's not limited to your world, but it is interesting how the thinking should therefore adjust to solutions for more than one and how that might work. And, this is a very complicated and difficult business, and the investing world shows us up for our frailties. And it's been very helpful to understand how Mercer's approached, this work. And I thank you very much, Jo, for being with us today on a cold March day.
Perfect. Thank you. It's been an absolute pleasure. Thanks, Simon.